All right, so Goodfellow, symbol GDL on the TSX, is a diversified manufacturer of value-added lumber products as well. It is a wholesaler of building materials and floor coverings. Goodfellow has a distribution footprint from coast to coast in Canada, servicing commercial and residential sectors through lumberyard retailer networks, manufacturers, industrial infrastructure project partners, and floor covering specialists. Goodfellow also leverages its value-added product capabilities to serve lumber markets internationally. The stock is trading up 9% year to date at the current value of $7.15 a share at a market cap of $121 million, paying a strong dividend yield of 7%. For fiscal Q3 2023, the company's sales fell by 17%, however, to $139 million. And for the year to date, sales fell 19.6% to $387 million. This really illustrates the shift in the lumber demand over the past year, as the post-COVID boom saw significant demand surge, resulting in many purchasers just overstocking on their inventory. And now that we are seeing more normalized demand, they have to work off this excess inventory before ultimately purchasing more lumber from Goodfellow, so it impacts their sales. Gross margin has remained relatively constant, though. It's at 22.7% for the quarter compared to 22.6% in the prior year, resulting, however, since the sales dropped, in a gross profit falling by 16.5% to $31.6 million. As well, SG&A remained materially flat. So as gross profit fell, we can see the negative side of having a heavily operationally leveraged company in any distribution. You really see this, resulting in a significant decrease year over year for net income to only $6.2 million, down from $10.6 million or 72 cents from $1.24 on a per share basis. As well, the year-to-date EPS fell by even more, by 55.4% to $1.47 from $3.30 a share. As well, due to the construction seasonality, Goodfellow is as well seasonal. So Q2, Q3 are normally the strong quarters, so we've really seen the year play out. Before the fourth quarter, you'll normally see quite a bit lower, and we'll actually see that in a couple slides coming up. So we can look at the 20-year quarterly earnings chart. We can see that EPS in recent years has just been significantly higher than historic norms. We can see the previous 20 years, it's roughly hitting the same levels for both EPS and sales. But then in that 2020, 2021, and a bit into 2022, the sales were just dramatically higher, which led to higher EPS. But you can also see that the percentage change in sales isn't very significant year over year or even quarter over quarter, but then it really trickles down into that EPS. So that change in sales just ultimately becomes the change in EPS. But when you're looking at the earnings per share versus the revenue per share, those small changes add up a lot quicker. As well, you can notice in this long-term graph that besides that 2020, 2021 period, they had really no growth the entire time. So moving to the balance sheet quickly, the company holds cash of $8 million, with the only debt being leases of $13.7 million, resulting in a net debt and leases of $5.8 million. This is after they have paid off bank debt of $31.6 million over the past year, which is good to see. With distributors in really any business, margins are so small that it can just quickly eat away at any profitability, especially with interest rates being where they are. As well, added on top, they are cyclical. So if you have a downswing with rising interest rates, it can just completely deteriorate the company's performance, and it's good to see that they got the debt off their balance sheet. Now, switching to valuations. Goodfellow is trading at a trailing PE of 7 times, which is well below their 10-year average of 10 times, which may just seem appealing as the company is below that average. However, you do need to remember if lumber demand specifically related to like single-family homes, which they're called out in their MD&A, if that continues to decrease, you could see further earnings decline, which would ultimately result in a higher PE trending towards or perhaps even above that average. So even though it does appear low, it may not be when you're looking forward. However, you probably aren't really looking at Goodfellow at the time for capital returns, given its historic price performance. You are probably looking at that 7% yield. The company at its current earnings has good dividend coverage, about 50% in their earnings over the past year, but that can quickly change due to what I've mentioned above. We can see with their historic dividend payments that they're not consistent at all. They'll continuously raise and cut as they see fit, as well as they at times it will issue special dividends during certain uprises and quarters, as well as only a semi-annual dividend normally, and then they also occasionally do special dividends. But you can see in 2018, during that period when the demand or their earnings were very low, they cut their dividend completely, and now we're really at an all-time high dividend. But that being said, they just this last quarter declared another 50-cent dividend, so they haven't cut it yet or decreased it yet, but that is something you would need to watch going forward, especially given their history. So our take, although the company does appear cheap with a high yield, the dividend really isn't safe by any means given their historic tendency and the earnings cyclicality. The valuation will likely come up as well if earnings were to drop, and that does seem to be where we're heading towards given the industry. They're really and the end result of their industry, they can't really do too much to really move that lever. So they really have to take what the industry gives them, and it's a cyclical and seasonal industry. As well, you cannot really expect growth from the company given its historic growth, but I will say their balance sheet's a lot better, so perhaps they could acquire something, and if there was a substantial decrease, you would see some cheap valuations for acquisition targets, and they could take on some debt at that time to produce non-organic growth, but I wouldn't be counting on that organic growth. So overall, I would just really pass on the company for now. There just isn't really a point to put your money in with the risks at hand, as well, given you would most likely be a dividend investor for this company, and the dividend is not really secure given its historic tendencies. So open up to you guys.
Yeah, I think that you sum that up perfectly. Really, it's you're investing in the company really for the dividend income, but the dividend income is not. I mean, that dividend can be cut quite quickly, and that seems to be the somewhat the expectation, or should be based on the historic performance of the company, right? So, yeah, right now they have good coverage, but earnings were down 50%. I mean, with that type of volatility in earnings, you don't know what the coverage is going to be starting next quarter.
Yeah, and the lack of growth you point out there. I mean, they had a huge uptick in earnings per share essentially, but the revenue profile didn't really increase well above their historic, peak, their peak multiple that they hit, or their peak figures that they were hitting essentially. So really, it's for me, it may look like a bit of a value trap if you're looking at where they are right now, and if earnings come down, then suddenly you don't even support the current price. It's up year to date this year with declining earnings, which is strange in this market. I know they've done a great job paying off debt. I mean, that's something that's likely high price debt or probably variable debt, which is a good thing in this market. Maybe, like Brett said, maybe there is an avenue to make acquisitions, but it doesn't look like a lot of organic growth, which is the growth that we would prefer to at least have in a business. And the valuations probably get more expensive as their earnings decline over the course of this year. Plus, they're facing an uncertain market. So I'd kind of watch out near term or midterm with Goodfellow.